Just when we thought we understood the trajectory of the global economy, the Federal Reserve has delivered a bombshell. In an unexpected and dramatic move, they've just announced a significant interest rate cut, sending shockwaves through financial markets worldwide. Are you prepared for the seismic shifts now underway? Hey, Ivy here. Let's talk smart money moves and what this surprise Federal Reserve decision means for your next investment decision. The financial world collectively gasped this week as the Federal Reserve, in a stark departure from its previously telegraphed intentions, unveiled an immediate and substantial cut to its benchmark interest rate. This wasn't merely a minor adjustment. It was a clear and assertive signal, dropping the federal funds rate by a significant X basis points, effective immediately. The announcement came from Federal Reserve Chair Jerome Powell during a hastily arranged press conference, catching analysts, traders, and investors completely off guard. For months, the consensus had been firmly planted on a higher-for-longer narrative, with the Fed signaling a patient approach to monetary policy, carefully watching inflation data before considering any rate adjustments. This sudden pivot has utterly upended those expectations. Within minutes of the news hitting the wires, markets reacted with dizzying volatility. Stock futures, initially surging on the prospect of cheaper borrowing costs for corporations, quickly retreated as uncertainty about the underlying economic conditions prompting such a drastic move began to take hold. Bond yields, which had been stubbornly high, plummeted, reflecting a flight to safety and revised expectations for future economic growth and inflation. The US dollar, typically a safe haven asset, saw a sharp depreciation against major currencies as investors reassessed its attractiveness in a lower rate environment. This wasn't just a policy change. It was a psychological jolt to the entire global financial system, forcing everyone from institutional investors to individual savers to reevaluate their positions and strategies in real time. The immediate question on everyone's mind: what exactly prompted this dramatic and unexpected course correction from the world's most influential central bank? The Federal Reserve's official statement and Chair Powell's subsequent remarks laid out a rationale that, while presented as carefully considered, still left many questions unanswered. The primary driver, according to the Fed, was a preemptive strike against what they perceive as accumulating downside risks to economic growth, both domestically and internationally. They pointed to softening global demand, particularly from key trading partners, and persistent supply chain disruptions exacerbated by ongoing geopolitical tensions. While inflation has been a stubborn concern, the Fed indicated that recent data showed a more pronounced deceleration than anticipated, giving them a crucial window to act. Furthermore, they cited a slight but noticeable weakening in certain segments of the labor market, suggesting that the previously robust employment picture might be starting to fray at the edges. This unexpected rate cut, therefore, was framed as an insurance policy, a proactive measure designed to sustain economic expansion and bring inflation back down to their 2% target more gently, rather than risking a more severe downturn. Powell emphasized that this was not a response to a crisis, but rather a mid-cycle adjustment aimed at ensuring the economy's continued health. However, critics were quick to point out the sudden shift in tone. Just weeks prior, the narrative was one of unwavering commitment to fighting inflation. This abrupt change has led some to speculate that the Fed might be seeing underlying economic weaknesses that are not yet fully visible in public data, or that political pressures might have played a more significant role than acknowledged. Regardless of the full truth behind the decision, the official narrative painted a picture of a central bank acting decisively to safeguard stability in an increasingly uncertain global economic climate. The immediate aftermath of the Fed's rate cut saw a dramatic repricing across virtually all asset classes, creating clear winners and losers in the process. On the winning side, growth stocks, particularly those in the technology and innovation sectors, experienced an initial surge. Lower interest rates reduced the cost of borrowing for these companies, fueling expansion and making their future earnings streams more valuable when discounted back to the present. Companies with heavy debt loads also saw a reprieve as their interest payment burdens eased. Bonds, especially long-duration U.S. Treasuries, rallied significantly, with yields dropping sharply. This is a classic response, as lower rates make existing bonds with higher fixed payments more attractive and also signal expectations of lower future rates, which boosts bond prices. Gold, often seen as a safe haven asset and a hedge against inflation or economic uncertainty, also saw a notable uptick, benefiting from the weaker dollar and lower real yields. Conversely, the losers were equally pronounced. Financial stocks, particularly regional banks, faced immediate pressure. While lower rates can stimulate borrowing, they also compress net interest margins, the difference between what banks earn on loans and what they pay on deposits. A flattening yield curve, often a byproduct of rate cuts, further squeezes bank profitability. The US dollar, as mentioned, depreciated against a basket of major currencies. A weaker dollar makes US exports more competitive, but makes imports more expensive and can negatively impact multinational corporations that convert foreign earnings back into a weaker dollar. Commodities, while mixed, saw some sensitivity to the dollar's movements. Energy prices, for instance, often have an inverse relationship with the dollar. This swift recalibration underscores the intricate web of connections within financial markets, where a single policy decision can trigger a cascade of consequences across diverse investment categories. Beyond the grand movements of Wall Street, the Federal Reserve's rate cut has tangible, immediate implications for the everyday finances of ordinary Americans and consumers globally. Perhaps the most direct impact is on borrowing costs. For homeowners, especially those with adjustable-rate mortgages (ARMs) or home equity lines of credit (HELOCs), a rate cut could mean lower monthly payments, freeing up disposable income. Those contemplating refinancing their fixed-rate mortgages might also find more attractive options, though the impact on long-term fixed rates is often less immediate than on variable rates. On the flip side, savers are likely to feel the pinch. High-yield savings accounts and certificates of deposit, CDs, which had become increasingly attractive during periods of rising rates, will likely see their interest rates decline. This means less return on your cash holdings, potentially prompting individuals to reevaluate where they stash their emergency funds or short-term savings. Credit card interest rates, which are typically tied to the prime rate, which in turn is influenced by the federal funds rate, might also see a slight reduction, offering a small reprieve for those carrying balances. However, don't expect dramatic drops here, as credit card rates already have significant spreads built in. For businesses, particularly small and medium-sized enterprises, the lower cost of borrowing can stimulate investment, expansion, and hiring, potentially boosting local economies. However, if the rate cut signals deeper economic concerns, this positive effect might be tempered by cautious consumer spending. Understanding these direct connections is crucial, because while the Fed's decisions might seem abstract, their ripple effects touch nearly every aspect of our financial lives, from the interest you pay on your car loan to the meager returns on your savings account. For savvy investors, an unexpected rate cut from the Federal Reserve isn't just news. It's a critical catalyst for reassessing and potentially adjusting portfolio strategies. The immediate knee-jerk reactions of the market may subside, but the underlying shift in monetary policy demands a thoughtful response. One key area of focus should be fixed income. With bond yields falling, existing higher-yielding bonds become more valuable, but new bond issues will offer lower returns. Investors might consider extending the duration of their bond holdings if they anticipate further rate cuts, as longer-duration bonds are more sensitive to interest rate changes. Conversely, those seeking income might need to explore dividend-paying stocks or alternative income strategies. In the equity market, the landscape shifts. Growth stocks, which thrive on cheaper capital and future expectations, could see renewed interest. However, value stocks, often more sensitive to economic cycles, might face headwinds if the rate cut signals a weaker economic outlook. Cyclical sectors, such as industrials and materials, could be hit if the rate cut is a preemptive move against a slowdown, while defensive sectors like utilities and consumer staples might offer more stability. Real estate, benefiting from lower mortgage rates, could see increased activity, making REITs, real estate investment trusts, an interesting consideration. It's also a time to reevaluate your exposure to international markets. A weaker dollar could make U.S. goods more competitive abroad, but it also means that foreign investments, when converted back to dollars, might see currency gains. Diversification remains paramount, but the composition of that diversification needs scrutiny. This isn't about panic selling or buying. It's about making informed, strategic adjustments to align your portfolio with the new economic reality shaped by the Fed's latest intervention. The Federal Reserve's unexpected rate cut has undeniably reset the economic playing field, but the lingering question remains: what comes next? Experts are now fiercely debating the future trajectory of monetary policy. Will this be a one-off insurance cut, or the first in a series, signaling a more aggressive easing cycle? Much will depend on upcoming economic data, particularly inflation readings, employment reports, and consumer spending figures. If inflation continues to cool faster than expected, and economic growth shows further signs of weakening, the Fed might be compelled to implement additional cuts. However, if the economy proves more resilient, or if inflation proves stickier than anticipated, the Fed could hold steady or even reverse course, albeit cautiously. Geopolitical factors also loom large. Ongoing trade disputes, conflicts in key regions, and shifts in global supply chains could all impact the Fed's calculus, potentially forcing further interventions or limiting their room to maneuver. The weaker US dollar, a direct consequence of the rate cut, has implications for global trade and currency markets, potentially fueling inflation through more expensive imports. For investors, this environment demands vigilance and adaptability. Volatility is likely to remain elevated as markets grapple with this new paradigm. Staying informed, understanding the underlying economic forces at play, and having a well-diversified portfolio are more critical than ever. The Fed's actions have painted a new picture of the economic landscape, one filled with both opportunities and challenges. Navigating this path successfully will require not just quick reactions, but a deep understanding of the forces shaping our financial future. So, what's your take on the Fed's surprise move? Are you adjusting your portfolio, or do you think the market is overreacting? Let me know in the comments below. If you found this breakdown helpful and want to stay ahead of these critical financial shifts, make sure to hit that like button, share this video, and subscribe to the channel so you never miss another essential update.